number of investment trends that we're looking at. The first and foremost one is really, I think, the search for yield. Interest rates around the world have been low for several years now. People, particularly retirees and people leading up to retirement, who are concerned about their levels of income, have started to look for perhaps more risky investments, which isn't always a good idea. We do believe that through sensible investment, there are still opportunities in traditional markets where there's a lot more safety and security around constructing portfolios that are able to give investors a reasonable lifestyle without too much capital risk attached. And of course, this is really important in the context of a world where bond yields are likely to normalize or commence their normalization in the US, and that's likely to lead to bond yields rising all around the world. This will have implications for all asset classes. Obviously, bonds themselves, which are negatively correlated with rising yields, so you could see some capital loss from the traditional bond markets. But in high quality listed property securities and good quality equity securities with strong dividend yields, we still think that investors can deliver reasonable income yields to their portfolios and hopefully some capital returns too. So I think those are really the key things. It's been on the right side of the yield play, and also making sure that you do have a high degree of capital protection built into the portfolios, because of course there are some downside risks which face the world this year, and we wanted to avoid those downside risks as far as possible. Obviously look at this from a South African's perspective. Obviously a foreigner, you would look at this from a slightly different point of view, but from a South African's perspective, for somebody bringing money to the market for the first time, we would really advocate that they avoid securities or shares that have got low dividend yields, that have delivered very strong returns over the last 3 or 4 years. The temptation for people might be to invest in some of the large industrial securities that have delivered very strong returns. We think there's better opportunities in the equity market, perhaps in the commodity space. Some of the large diversified commodity companies like Anglo's and Billiton, perhaps. We think that there's value in some of the retailers which had a poor year last year, and we think that there's some good long-term value in some of particularly the banks. So for investors looking to rebalance their portfolios, we would say one could still be exposed to the equity market, and we think that those 3 sectors that I mentioned are likely to deliver the best results. And of course, then we still like the listed property sector, even though people are always fearful about listed property having negative returns when bond yields rise. We still think that there's a number of listed property companies, I beg your pardon, that have got good forward-looking dividend yields, and we think the distribution growth of 7 to 9% is likely to be delivered by those companies. So we think that as a proxy for government bonds, listed property is likely to deliver better returns looking forward for 2014. And then of course, from a local versus offshore perspective, we think that there's going to be some rand weakness leading up to the elections this year. There's going to be some robust discussion around different political ideologies leading up to the elections, and this might cause some discontent amongst foreign investors, and we will probably will see some volatility in the rand leading up to that election period. So having 20 to 25% offshore exposure in a client portfolio is probably a sensible thing to do, at least for the first half of this year. Of course, we would advocate people avoid cash, given that cash yields are so low, they're delivering negative real yields, and anything longer than sort of 6-month investment in cash is probably not a great idea. Global markets are really, in many respects, very similar to what we're seeing in South Africa. At a headline level, indices are expensive, asset prices don't look that cheap, but we're likely to see interest rates remaining very low, these low levels, at least through 2015, perhaps even into 2016. What we really need to see from global markets is an increase in top-line growth, particularly from the equity market. At the moment, cost cutting has been a driver of profitability. You need to start seeing top-line growth coming through. So we broadly think that is that's going to happen. It's not going to happen in any meaningful way, but we think that equity markets in developed world are likely to deliver 7 to 8% in nominal terms, which is well above global inflation rates, and so a very similar theme. Stock selection within the global context, choosing companies that have got strong dividend histories, good dividend yields, and similarly we can find global real estate securities that meet those criteria too. So conservative portfolios focus on downside risk, but take advantage of companies that have got strong balance sheets and are likely to grow their profits at above inflation in the next 12 to 18 months. We think that that strategy, both globally and domestically, will deliver above inflation returns this year, but the rate of the return is likely to be much lower than 2013.